President Donald Trump will impose new tariffs on US imports starting today. But, not surprisingly, the main targets, Canada, Mexico and China, have already hit back with counter tariffs. Bitcoin has dropped 12%, while Ethereum, the altcoin's flag bearer, has plunged by 45%. It's true that whales are absorbing a lot of the sell pressure as Bitcoin continues to fall. If you look at it now, the 10-year yield has dropped to around 4.2% and that downward trend seems to be continuing. This could mark the beginning of a very meaningful shift, and it's definitely a development worth keeping a close eye on. Tariff Day, big change upcoming! Hey Crypto Sensors, welcome back! It's great to have you here for our April 2nd updates. We've got a big day ahead, so let's dive right in. Today is T-Day or Tariff Day, and it's finally here. President Donald Trump will impose new tariffs on US imports starting today, a move he's called Liberation Day. Now, the big question is, will he go with a blanket tariff across the board, or will he take a more selective approach, applying different rates for different countries? Some analysts believe he might use the so-called reciprocal tariff strategy, adjusting rates based on negotiations. But, not surprisingly, the main targets, Canada, Mexico and China, have already hit back with counter tariffs. And now, even the EU seems ready to join the fight. This trade war is heating up fast, and the ripple effects could shake global markets. Since February, Trump's back-and-forth trade policies have kept markets on edge. Investors are struggling to figure out whether these tariffs are here to stay, or if they are just a bargaining chip to squeeze concessions out of America's economic partners. And with Bitcoin already facing pressure, currently sitting in the mid-82K range, the big question is, how will crypto react to this latest shakeup? So, today we will break down what's happening with the flow of money, how it's impacting the crypto market, and how we should approach this situation. Stay tuned, because we are breaking it all down next. This is April already. Time to do a quick recap of the first 2025 quarter. It has been a challenging season for crypto. Bitcoin has dropped 12%, while Ethereum, the altcoin's flag bearer, has plunged by 45%, one of its worst quarters ever. And the poor performance of Ethereum speaks for the whole altcoin markets. Now, when looking at the future Bitcoin markets, Bitcoin recently dipped to 81K, briefly rebounded to 84K and then settled in the 82K range. Above, you can see that the short position here at 84K was tested but not broken. And in the case below, you can see that it shook both sides while continuously hitting near 81K. Now, let's take a look at the altcoin book. If you look here, the buying wall on the order book has disappeared. When the buying wall disappeared, there was a short-term decline. This is a section that requires a little caution, but you can see that the order book is being partially filled again. The fact that the order book is being filled means that people are now showing their will to support, and you can see that Bitcoin has rebounded. In the short term, the 80K line is so important, so for now, they show their willingness to accept it on the order book. Short-term trends depend on whether these levels are breached or held. Altcoins are underperforming compared to Bitcoin, with long positions being liquidated more frequently. Bitcoin and altcoins are going through really tough times, but this happens in all asset markets. In the case of US stocks, it was the 5th fastest decline in the history of US stocks, and it was the 5th worst failure since the 1950s, including the post-Great Depression era. And with the tariffs issue, we can see the market is suffering at an unprecedented level. Altcoins are underperforming compared to Bitcoin, with long positions being liquidated more frequently. Delinquency rates are rising too. I don't want to push at an open door, but if we take a look at the Freddie Mac's serious delinquency rates, which represents the percentage of multi-family loans that cannot repay their loans, since 2022-2023, delinquency rates have started to climb again. And as of January 31st, 2025, they've hit a high of 0.42%. What is concerning here is that this number shows the rate of mortgage defaults in the US. It is actually higher than what we saw during the 2008 financial crisis. In past economic cycles, when interest rates went up, they'd usually end up cutting them back down, which helped calm things down. But this time, those rate cuts haven't been enough to stop the market from crashing. And what's really worrying is that back then, 25% of the US households were invested in stocks, the highest participation we've ever seen. But as US stocks took a dive, the extra cash these households had vanished. And now we are seeing a lot of financial pain. This trend is now directly feeding into the rise in mortgage delinquencies, which is even worse than what we saw during the 2008 housing crisis. A lot of households are struggling to pay their mortgages, which really highlights just how bad things are now and raises serious questions about the financial stability in the US. I mentioned the order book a little while ago, but the beginning of April is a crucial period. The 80K price level is also critical for Bitcoin's short-term trend. If Bitcoin manages to hold above this level and rebound, it could signal a positive trend for April. However, failing to maintain this support could lead to further declines. Look at the image. We can see a vertical blue line placed at April 12th, which acts as a critical inflection point. Green lines, representing bullish trends that began before April 12th, typically continue their upward trajectory throughout the remainder of the month. Red lines, representing bearish trends that start before April 12th, similarly continue their downward movement after these dates. Since today is April 2nd, 2025, we are currently in that crucial period where the trend being established will likely define Bitcoin's performance for the entire month. This is why the 80K support level is so critical right now. So, you can confirm that it is a very important line. If Bitcoin can maintain support above 80K and initiate a rebound in the next 10 days, historical patterns suggest this positive momentum will likely continue through the rest of April. Conversely, if Bitcoin breaks below the 80K support level before April 12th, we could see continued bearish movements for the remainder of the month. As I say in the title, it is more difficult market than the 2024 adjustment period, but at the center is liquidity constraints. Central banks have not released sufficient liquidity into global markets, and retail investors remain sidelined, avoiding the crypto markets. And in 2024, since the Nasdaq showed good movements, even if the coin market wasn't that great, it showed a rebound to some extent. In the same case, the entire market is collapsing, and since money is not circulating, if you look at the demand and supply of retail investors, you can see that it is negative. Way more than 2024 levels, you can see there. And the sell pressure is added. You can see that the coin market is going through rough time, but I am becoming redundant. It's true that whales are absorbing a lot of the sell pressure as Bitcoin continues to fall. They are providing liquidity on the way down and stepping in with support during dips. We are clearly in a tough market right now. But if these whales are still active and choosing to stay in the game, we need to seriously consider what might come next. Now, here's something important, and it's not being talked about much lately, but it matters. In April, the issuance of US Treasury bonds is expected to slow down, which means a reduced supply. This has a direct impact on the Treasury market, especially bond yields. If you look at it now, the 10-year yield has dropped to around 4.2%, and that downward trend seems to be continuing. This could mark the beginning of a very meaningful shift, and it's definitely a development worth keeping a close eye on. On a more macroeconomic level, tariffs start on April 2nd. The countries involved will have a very difficult time. In line with that, China is preparing to solve this problem to some extent by injecting liquidity into its economy. The People's Bank of China has shifted from relative quiet in March to actively preparing significant stimulus measures. This is evident in the sharp increase in China's M1 money supply, which has surged to 109.44 trillion yuan in early April 2025. The graph highlights this sudden jump, reflecting a substantial injection of liquidity into the economy. This move likely aims to mitigate the adverse effects of tariffs and other economic pressures, signaling proactive efforts by the People's Bank of China to stabilize growth and support financial markets. If we look at the United States money supply, M2, it's evident that liquidity is gradually returning to the markets. The graph shows a steady increase in M2 since mid-2023, following a period of contraction. As of now, M2 stands at 21.67 trillion US dollar, approaching its previous all-time high from 2022. This trend suggests that the US is nearing the end of its quantitative tightening, or QT, phase, or what can be referred to as cut-in tapering. Once this tapering concludes, liquidity is expected to flow more freely into the economy. This increase in liquidity could have a significant impact on financial markets, potentially stabilizing them and driving assets price higher. It's important to monitor how this liquidity affects various sectors and where it flows next. Timing will be critical in understanding its influence on markets like stocks, real estate, and cryptocurrencies. So, what does this tell us? Both China and the US are clearly ramping up liquidity, but they are doing it in very different ways. It seems like both economies are responding to economic pressures, likely the new tariffs, and trying to stabilize things. But I think this could be good news. As these massive liquidity injections hit the markets, some of this cash is likely to flow into risk assets like Bitcoin and other cryptocurrencies. Historically, Bitcoin tends to perform well in high liquidity environments, especially when investors are looking for alternatives to traditional currencies that are expanding rapidly. That said, we might still see some short-term uncertainty because of the tariffs and other economic adjustments. But looking at the bigger picture, the medium to long-term outlook for Bitcoin seems pretty optimistic. This kind of unprecedented liquidity surge could act as a major tailwind for Bitcoin prices. Of course, timing is key. The market will need some time to stabilize before we see the full impact of this liquidity wave translating into sustainable price growth. But overall, things are looking promising for Bitcoin in this environment. As usual, understanding the course of gold might be of some use. Gold continues to break its all-time high. This graph clearly shows how the cost of producing gold has been rising alongside its market price over time. This trend makes sense. When mining costs go up due to things like higher energy and labor expenses, the price of gold tends to follow, pushing it to new all-time highs. Interestingly, we see a similar pattern with Bitcoin. Just like gold, Bitcoin's mining hash rates and production costs have been climbing steadily. In both cases, these rising costs act as a sort of price floor, reinforcing the fundamental strength of each asset. This suggests that demand for scarce assets like gold and Bitcoin remains strong, even as they become more expensive to produce. And this is a key signal in financial markets. When gold stabilizes at higher levels, it can indicate shifts in liquidity and investor sentiments, trends that could eventually spill over to Bitcoin and other alternative assets. In fact, Bitcoin's mining hash rate and mining costs are both on the rise. This shows that Bitcoin's fundamentals remain intact and have not been significantly damaged, so far for now. There's no major issue. What we really need to focus on is the release of liquidity. Gold is rising first, which is often a leading signal. Once the market begins to stabilize, the key will be watching where the money flows next, and that timing will be absolutely critical. So, I will wrap up today's video with that thought. If this video was helpful, please subscribe, like, share, and leave a comment. Your support means a lot. Thank you so much for watching, and I will see you in the next one.